Welcome to the Deep Dive, your shortcut to being instantly well-informed. Today, we're cutting through the complexity of earnings reports.
Yep, and the one we're tackling is AutoZone's Q4 2025 call.
Exactly. This one caught our eye because, well, the market reaction was pretty cautious, wasn't it? Stock dipped.
It did. Suggests investors maybe had hung up on the headlines, maybe a bit spooked.
Right. But when you dig in, the underlying story, it seems like there's some significant strength in how they're actually running the business.
That's what we need to unpack. Where's the real story hiding behind those initial numbers?
Okay, let's start with those results that maybe caused that hesitation. What were the headline figures?
So GAAP diluted EPS came in at $48.71.
And the street was looking for?
Consensus was around $50.60. So, yeah, a miss, about 4% short.
Okay, a miss on earnings. What about the top line, revenue?
Revenue was pretty much right there, basically in line at $6.24 billion.
So profit missed. Sales basically hit expectations. Interesting. How did management spin that? Or rather, what did they emphasize?
Well, they immediately pointed to the top line strength, which honestly is there. You got to adjust for last year having that extra 53rd week, remember?
Right. That always complicates the year-over-year comparison.
Exactly. So adjust for that. And total revenue growth was actually pretty robust, 6.9% year over year.
Okay, 6.9% adjusted growth. That's solid. And same-store sales?
Strong there, too. Total company same-store sales, or SSS, grew 5.1% on a constant currency basis.
5.1%. That is a strong number in this space.
That really is. And you still see that kind of two-speed business model playing out. Domestic SSS was up 4.8%, which is good. But international, that's Mexico and Brazil is the real star again, up 7.2% SSS constant currency.
Wow. Okay. International's still firing on all cylinders.
Definitely.
All right. So that brings us to the, let's call it the core puzzle of this report. Profitability. Sales look good, especially adjusted, but that EPS missed. Gross margin fell. Well, nearly a full percentage point.
Yeah, 98 basis points year over year, a big drop. That's despite them saying merchandise margins actually improved a bit.
It wasn't discounting or promotions killing margins. What gives?
It really boiled down to one major thing.
Yeah.
A huge $80 million non-cash LIFO charge.
LIFO. Last in, first out accounting.
Okay, refresh us quickly. Why does this specific accounting method cause such a big hit to reported profit without necessarily meaning the business itself is struggling operationally?
Right, it's crucial to get this. So prices are going up, right? Tariffs, supplier costs, inflation.
Yeah, we're seeing that everywhere.
With LIFO, you have to match the cost of your most recently purchased, most expensive inventory against your current sales. So that higher cost hits your cost of goods sold immediately. Boom, reported gross margin goes down.
Even if the actual profit on older inventory is fine. Exactly. But here's the key. It's non-cash. It looks bad on the income statement, makes the EPS number look weak, but it's not cash actually leaving the business. It's an accounting adjustment reflecting inflation. That $80 million charge alone was a 120 basis point headwind to gross margin.
128 basis points, so more than the entire 98 basis point decline. That context changes everything.
It really does. It means the EPS miss was largely, maybe almost entirely, down to this accounting rule reflecting inflation, not a failure in sales or core profitability.
So management's argument was basically ignore the accounting noise.
Pretty much. They said, look, if you normalize for this LIFO hit and that 53rd week comparison from last year, our operating income, EBIT, would actually have grown 5.5%.
And EPS?
EPS would have been up 8.7%. A much healthier picture.
Okay, so the profit miss feels much more like an accounting story than an operational one.
That seems to be the case here.
All right, we've tackled the accounting fog. Now let's pivot to something that looks unambiguously strong, maybe something the market overlooked in that initial reaction. The commercial business, domestic commercial, it seems like it really picked into high gear.
Oh, absolutely. It was massive. Domestic commercial same-store sales accelerated to plus 12.5% on a 16-week basis.
12.5%. How does that compare to recent quarters?
Just to give you context, it was 10.7% in Q3 and 7.3% back in Q2. So you're seeing a clear, significant acceleration. They are definitely taking share in that do-it-for-me professional market.
That's huge growth. And the DIY side, the regular retail customer?
That was still positive. Domestic DIY SSS grew 2.2% for the quarter. Respectable, but yeah, that commercial number is really driving the growth engine right now.
What's fueling that commercial boom? What did management say?
They pointed to better execution, things like faster delivery times, having more parts available when the mechanic needs them, and really leveraging those investments they've been making in hub and especially mega hub stores.
Right. The mega hubs carry a much wider inventory.
Exactly. Over 100,000 unique parts. That allows them to serve those professional shops much better, especially for more complex or time-sensitive jobs. It seems to be paying off.
Okay, let's shift focus to the future then. Did they give formal guidance for fiscal 26?
No formal quantitative guidance, which
No.
isn't unusual for them. But the strategic direction was crystal clear. Keep investing, keep expanding. Aggressively.
How aggressively? They opened a lot of stores in FY25, right?
A record pace, actually. 304 net new stores. They said it was the most since 1996.
Wow. And for next year?
They're planning to accelerate even more. The plan is for 325 to 350 new stores across the Americas in FY26.
Okay, that's a big buildup. What does that mean for spending?
Capital expenditures, or CapEx, is going to jump to about $1.5 billion. And yeah, a lot of that is earmarked for these new stores, especially those hubs and mega hubs that fuel the commercial growth.
Now, opening that many stores, that's got to put pressure on costs initially, right?
Yeah.
SG&A.
It does. New stores aren't immediately profitable. Management said it takes about 4 to 5 years for a store to fully mature and hit its stride.
So that explains some of the cost pressure we saw, SG&A deleverage.
By 80 basis points year over year, yeah. But management was very clear. They see this as strategic investment, building scale for the long term. It's not, in their words, an arms race on costs with competitors. It's a deliberate plan that requires upfront spending for future growth.
Okay, purposeful investment. But going back to that LIFO charge, if it's tied to ongoing inflation and tariffs, it sounds like it's not just a one-quarter blip. What are they expecting going forward?
Yeah, good question. They expect it to continue. They actually guided for a $120 million LIFO charge just in Q1 of FY26.
Oof, even bigger than Q4.
Yep. And then they expect $80 million to $85 million per quarter after that for the rest of FY26. So this accounting headwind on reported EPS, it's sticking around for a while.
So investors need to keep that normalization in mind when looking at the quarterly EPS figures next year.
Absolutely. The reported numbers will likely continue to look constrained because of LIFO.
What about the customer, though? All this inflation, are they seeing pushback on price?
They emphasize demand is holding up well. It's mostly break-fix stuff, right? Your car breaks, you need the part. There isn't a ton of wiggle room for the consumer to just not fix their car.
Less discretionary.
Exactly. And they pointed out the average ticket, especially for DIY, is still relatively low, maybe $35, $40. So even with some price increases, it's not breaking the bank for most people. Elasticity seems pretty low.
Makes sense. And quickly back to international, still strong sales, but any other factors? Currency.
Yeah, international SSS was great, 7.2%. But the weaker Mexican peso actually hit them hard on the translation back to US dollars in Q4. It was a 57-cent drag on EPS.
Wow, that's significant.
It is. But the flip side is, based on recent exchange rates, they expect FX to become a tailwind in Q1 FY26. Could add maybe 38 cents back to EPS. So lots of moving parts.
Definitely a complex picture. Okay, let's shift gears. All right, standard disclaimer time. This is not financial advice.
Absolutely not. This is just us taking the information from the call and spitting out a, let's call it, outrageous but plausible trade idea based only on that source material, purely for discussion.
Got it. So considering that initial stock drop, maybe 2-3% right after the earnings hit, what's the hypothetical play here?
Okay, the core premise is simple. The market seems to have reacted primarily to that LIFO accounting noise, which is quantifiable and, importantly, non-cash.
And maybe miss the underlying operational strength.
Exactly. Missed the accelerating commercial growth, the strong cash generation. So this dip looks like a potential false signal, an entry point based on accounting, not fundamentals. Remember, they generated $1.8 billion in free cash flow in FY25. That cash flow is real, regardless of the LIFO charge.
So the trade focuses on the cash and what they do with it.
Precisely. They have this durable strategy, use that strong cash flow to fund the store growth, especially those high-potential mega hubs, then take the excess cash and plow it back into share buybacks.
Compounding value for shareholders.
Right. They bought back almost $500 million worth of stock, $447 million, just in Q4, at an average price over $3,800 a share. That tells you management thinks the stock is valuable even at those levels.
Okay, so what's the actual trade idea?
You go long, maybe a substantial position. You use that post-earnings dip triggered by the LIFO headlines as your entry.
And the rationale is?
The rationale is that this LIFO headwind is temporary, or at least quantifiable and understood. Eventually, either inflation cools or the market fully digests the impact. When that happens, or even before, that strong, consistent top-line growth, 5% plus same-store sales, combined with the leverage from the expanding store network, will start flowing through much more cleanly to the bottom line. You're betting on the long-term operational execution and that disciplined capital return eventually overwhelming the short-term accounting noise.
It's a patience play. Betting cash flow wins out over accounting adjustment.
That's the idea. Betting on the underlying engine, not the temporary smoke from the LIFO charge.
Okay, interesting thought experiment. Let's wrap this up.
Sounds good.
So, to summarize our deep dive on AutoZone's Q4, the stock's immediate reaction seemed very focused on that accounting quirk, the non-cash LIFO charge.
Yeah, the noise.
Well, the operational reality seems, well, pretty solid. You've got accelerating commercial growth, strong international numbers, and this very aggressive strategic plan to expand their store footprint. It looks like a company executing well for the long haul.
Yeah, so what does this really mean for you, the listener? I think this quarter just reinforces their multi-year story. They're steadily gaining share, diversifying internationally. Any short-term stock wobbles seem more tied to things like LIFO accounting or FX rates rather than fundamental problems with demand or how they're running the business.
Right. And maybe here's a final thought for you to chew on. Management is clearly betting big on these new stores, especially the mega hubs. They accept the initial SG&A drag. The big question for fiscal 26 and beyond is, can that underlying growth, fueled by cash flow and buybacks, consistently overpower those expected LIFO headwinds and justify that investment? It's a real test of their strategy and discipline, especially if inflation stays sticky.
A fascinating dynamic to watch unfold. Investing today for tomorrow's profits while navigating today's accounting pressures.
Indeed. Thanks for joining us for this deep dive. We'll catch you next time.